Your phone buzzes. Bro, if I earn more, I'll fall into the next tax bracket and take home less. So I'm rejecting the raise. You stare at the message like it just confessed it eats biryani with ketchup. Before this ends, you'll know exactly why that fear is wrong, how brackets really slice your income, and how to estimate your real extra money from a raise in under 2 minutes. Without spreadsheets, without headaches, that belief feels true for a reason, because taxes are explained like a horror story. A new bracket sounds like a trap door, like the government is standing there with a net, waiting for you to step 1 rupee too far. And if your pay slip already looks like it was attacked by a stapler, you're not in the mood to test theories. But the hidden mechanism is simple. Tax brackets are not a cliff. They're a staircase. Only the last slice of your income gets taxed at the higher rate. Your earlier income keeps its lower rate. No trapdoor. No sudden, now everything is taxed more. That's the myth. And the villain pushing that myth is the bracket boogeyman, confusing charts, dramatic headlines, and that one uncle who treats payroll deductions like black magic. Picture your income as a plate of golgappe. Each golgappa has different spice. The first few are mild, then they get hotter. If you pick up 1 extra golgappa, it doesn't magically make the earlier ones burn your face too. Only the new one is hotter. That's how marginal tax rates work. Pause. Let that settle. Okay, micro story time. You're in Karachi or Delhi or Dubai. Doesn't matter, the feeling is the same. You earn 200,000 a month. You finally get offered 230,000. You're excited for 12 seconds. Then your brain whispers, new bracket, RIP. And suddenly you're negotiating against yourself like you're on a reality show. Let's do the easy math reveal. Not with formulas, with slices. Imagine a simplified system. First 100,000 is taxed at 0%. Next 100,000 is taxed at 10%. Anything above 200,000 is taxed at 20%. Again, simplified to make the point. At 200,000, your first 100,000 pays 0, your next 100,000 pays 10%, which is 10,000. Total tax, 10,000. Take home, 190,000. At 230,000, your first 100,000 still pays 0. Your next 100,000 still pays 10%, error 10,000. Only the extra 30,000 is in the 20% zone, cheering 6,000. Total tax, 16,000. Take home, 214,000. You didn't lose money, you gained 24,000. Your raise didn't get eaten, only part of it got nibbled. Micro payoff number 1, the bracket only bites the top layer, not the whole cake. Now your brain will try to sabotage you with a different confusion. Withholding. That's the amount your employer cuts every month, like, trust me bro, this is tax. Sometimes they withhold more than your final tax bill, sometimes less. Sometimes it feels random because it's based on estimates and payroll settings. So you look at 1 month, see a bigger deduction, and your brain screams, see, cliff! But that's not the system punishing you. That's payroll guessing. Micro payoff number 2. Your payslip is a prediction, not the final judgment. And there's a third sneaky confusion, bonuses. A bonus can get taxed differently at the moment it's paid or withheld more aggressively, so it looks like you were robbed in broad daylight. Next month you think you're safe, so you spend the bonus. Then tax season shows up like a quiet bill collector, and your wallet does the slow motion fall. Micro payoff number 3, bonuses distort the view, but they don't rewrite the bracket rules. So why do humans fall for this? Because we hate the idea of crossing a line. Your brain loves clean categories, rich, poor, safe, danger, inside, outside. A bracket sounds like a line, and marketing loves lines too. Banks, car dealers, phone companies, they sell you the monthly payment, not the total cost. Taxes get sold the same way, a big scary percentage with no context. Your brain sees 20% and forgets the earlier 0% and 10% even exist. It's called scope neglect, but you can call it, my brain zoomed in and panicked. Also, your ego hates the feeling of working for the government. You'll say it out loud, if I get a raise, half goes to tax. And sometimes for the top slice, yes, a chunk goes, but half of the whole paycheck, usually no. That sentence is emotional math, and emotional math is how you end up broke with a fancy phone and no emergency fund. Pause lines. Ouch. Still love you. Now let's address the common objections, because you're thinking them right now. Objection 1. But my friend got a raise and his take-home dropped. Explain that. Easy. Either payroll withholding jumped temporarily, or he lost a benefit. Maybe he crossed the threshold for a subsidy, a rebate, an allowance, or an employer contribution. That's not the bracket system being a cliff. That's a separate rule acting like a cliff. Sometimes there are real cliffs, benefit cliffs. But brackets themselves are stairs. If your take-home fell, hunt for the other rule. Health insurance tiers, pension match caps, overtime rules, loan repayments, or salary packaging changes. Objection 2. Okay, but high earners do pay more. So what's the big deal? Yes, they pay more because they earn more. That's the point. The trick is knowing your marginal rate versus your effective rate. Marginal rate is the tax on your next rupee. Effective rate is total tax divided by total income. That second one is usually way lower than the scary headline bracket. So when you're deciding on a side hustle over time or a job switch, marginal rate matters for the decision, effective rate matters for your overall planning. Different tools, different jobs, same brain, less panic. Objection 3. So should I avoid earning more to stay in a lower bracket? No. Unless earning more causes you to lose a separate benefit that's worth more than the extra income, which is rare but possible. And even then, the move isn't reject income. The move is optimize the timing, the deductions, or the structure in legal, normal ways. For example, contributing to approved retirement accounts, using legitimate business expenses if you're self-employed, or planning your bonus timing if you have control. Not cheating. Just planning, because the villain isn't you making money. The villain is you not understanding the rules and then making fear-based choices. Let's make this even more real with a second micro story. You're freelancing on the side. You made $300,000 extra this year. You're proud, then terrified. You imagine that extra income will push you up, and suddenly the government takes a huge chunk of your entire salary. So you think, maybe I should stop freelancing. Peace. That's like quitting the gym because you saw sweat. The correct move is to estimate the top slice tax, set it aside, and keep the income. Because if you keep 70% of your extra work, that's still a win. And you can plan for it so it doesn't feel like a surprise punch. Now, a catch people miss. If you don't understand brackets, you don't just lose money to tax. You lose money to fear. Fear makes you reject raises. Fear makes you avoid promotions. Fear makes you undercharge clients. Fear makes you stay comfortably broke because it feels safer than being confused and earning more. That's expensive, and it's silent. No receipt, no notification, just years. So tonight, you're doing a simple plan. 2 versions. One for when you're broke and overwhelmed. One for when you're stable and ready to optimize. Quick reality check with a scene you've lived. It's 11:47 p.m. You're lying on the bed, scrolling job posts. One offer is a little higher. Your thumb hovers. Then the bracket boogeyman shows up wearing a suit made of confusing percentages. He whispers, "Don't be greedy. Stay safe. You'll get taxed more anyway." And you almost listen, not because you're lazy, because your brain is trying to protect you from pain. This is where the monthly payment illusion teams up with the boogeyman. You don't feel taxes as an annual total. You feel them as a small monthly stab. So you compare monthly stabs, you see a new stab, and your brain assumes the whole body is getting stabbed. Dramatic, but that's exactly how our emotions work. Let me show you a more realistic, slightly messier example, the kind that actually happens. Say your current monthly gross is $250,000. Your take-home is $210,000. You see $40,000 missing and you're like, okay, fine. I guess I'm officially a taxpayer now. Then you get a raise to $280,000. Next payslip, take-home is $232,000. You gain $22,000. But the deduction line jumps from $40,000 to $48,000. And your brain screams, I got robbed. No, you got a raise. The deduction increased because your extra income is being taxed at a higher slice. That's normal. The mistake is staring at the deduction increase instead of the take-home increase. The boogeyman wants you to focus on the wrong number. Here's a tiny trick to keep you sane. Compare the difference in take-home, not the difference in deductions. If take-home went up, you're winning. If it didn't, something else changed. And something else is where your real investigation begins. Now, the most dangerous misunderstanding is the word rate. When someone says, I'm in the 20% bracket, your brain hears, I lose 20% of everything. But what it actually means is, the top slice is taxed at 20%. A better way to speak is, my top slice is 20%, my overall is maybe 7-12%, depending on deductions and slabs. That single language swap reduces panic. Because language shapes fear. Let's do another step-by-step math reveal, even simpler. Imagine your income is a tall glass of mango lassi. The glass has 3 markings. Below the first mark, you add 0 sugar. Between mark 1 and 2, you add 1 spoon. Above mark 2, you add 2 spoons. If you pour in more lassi, do you go back and add 2 spoons to the entire glass? No. You only add the extra spoons to the part above the line. Otherwise, the bottom becomes a dessert weapon. Same concept, different kitchen. And yes, there are real cliffs in money. This is important, because if you only hear, "there's no cliff," you'll get blindsided by an actual one and stop trusting anyone. So here's the clean separation. Tax brackets, stairs. Benefits and eligibility rules, sometimes cliffs, examples, a scholarship cutoff, a subsidy, a low-income utility discount, a family allowance, even certain loan programs. Cross the line, and you might lose a perk. That's not tax brackets being evil. That's a different rule with a different purpose. So if you ever see take-home drop, ask, did I lose a benefit? Not, did my whole salary get taxed more? Now let's talk about why the boogeyman survives year after year, because confusion is profitable. When you're confused, you don't negotiate hard, you don't switch jobs, you don't start the side hustle, you don't ask for a proper invoice, you don't track expenses, and then you pay more than you needed, not because the law demanded it, but because your life stayed chaotic. Confusion is a tax of its own, a private tax, paid to nobody, but it still hurts. Also, people love dramatic stories. No one watches a movie called "He Earned More and Took Home More as Expected." But everyone forwards the WhatsApp message that says, "My cousin got a raise and got poorer." And you never see the details, like, he started a new loan repayment, he changed from contractor to employee, he lost a travel allowance, he stopped getting overtime, he moved cities, he got a one-time bonus that was withheld heavily. The story gets simplified into a myth. Then the myth becomes advice. And now you're scared of success because someone else's story got edited like a viral reel. Let's add a proof stack with a friend you know. Call him Ayan. Ayan earns $120,000. He's offered a promotion to $150,000. He says no, because he heard new bracket means more tax means less money. 6 months later, the company hires someone else at $160,000 for that role. Ayan is still at $120,000, but now he's doing half the work anyway because the new guy is learning. So Ayan did the extra stress, but rejected the extra pay. That's not a tax problem, that's a fear problem. Now do the math. Even if the extra $30,000 was taxed at, say, 20% on the top slice, he'd still keep $24,000. Over 6 months, that's $144,000. That's rent. That's a laptop. That's an emergency cushion that stops you from begging your future self. And he threw it away because of a misunderstanding. Now flip it. Your friend Sana takes the promotion. She assumes the top slice will be taxed higher, so she creates a tax parking account. Every payday, she moves a fixed percentage of her income into it, not because she loves taxes, because she loves not panicking. At the end of the year, if she oversaved, it becomes her bonus. If she undersaved, she adjusts. Sana isn't smarter than you. She just uses a system that doesn't require courage every month. And let's be honest, part of this fear is also social. You'll hear, "Bro, don't show too much income, nazar lag jayegi." Or, "If you earn more, you'll be in trouble." So you keep your earnings small, messy, hidden. Then you wonder why you can't get a better loan rate, a visa, a decent rental contract, or a clean business record. You can't build stability on shadows. That doesn't mean you broadcast your income. It means you stop self-sabotaging because of superstition and half information. Okay, second pattern interrupt. Record scratch. The government is not waiting behind a bush to make you poorer the moment you improve. Your own misunderstanding is doing that job for free, and it doesn't even take lunch breaks. One more aha that saves people. The effective rate tends to rise slowly. It doesn't jump like a switch. So when you plan your lifestyle, don't plan like your whole income is being taxed at the top rate. Plan with your effective rate and buffer with your marginal. That's it. Two numbers, two jobs, that's the whole game at your level. And if you want a quick mental shortcut for raises, for every 10,000 extra you earn, assume you keep somewhere between 6,000 and 9,000, depending on your marginal rate and deductions. Not perfect, but enough to make decisions without fear. You can refine later. Your goal is to move forward, not to win a math contest. Also, a tiny warning. Lifestyle creep is always lurking. You get a raise, you upgrade your phone, your food delivery, your weekend plans, your just one more subscription. Then the raise disappears and you blame taxes. Taxes didn't eat your raise. Your new habits did. Lifestyle creep is the boogeyman's cousin. They hang out together. They both love monthly payments. So when you get a raise, your first move isn't buying a new watch. Your first move is assigning the raise a job. Some for tax parking, some for debt or emergency fund, some for joy. Yes, you're allowed to live, but give the money instructions before the world gives it temptations. All right, you've got the model, you've seen numbers, you've seen psychology. Now we go practical. One last sneaky point. If you're comparing two jobs, ask for the annual gross and the annual net estimate, not just the monthly figure. Some companies pay 12 months, some 13, some 14 with bonuses. Two offers can look identical monthly and wildly different yearly. The boogeyman loves hiding in calendars. And if someone flexes a bracket percentage at you, ask them one question. What's your effective rate? Watch the confidence evaporate. Quietly satisfying. Okay, if you're broke or overwhelmed, step 1, find your last month's gross income. Not take home, gross. Step 2, find your total deductions labeled as tax or income tax. Just that line. Step 3, divide tax by gross. That's your rough effective rate for the month. If you paid 10,000 tax on 200,000 gross, that's 5%, not 20%, not scary. Step 4, for any extra money you might earn next month, overtime, freelance, bonus, assume your marginal slice might be higher than your effective rate. So if your effective is 5%, assume 15% to be safe. Set aside 15% of the extra income in a separate jar, account, envelope, whatever. When tax time comes, you won't get bullied by surprise. You'll be the one saying, nice try. Also, if you're really tight, don't overthink investments tonight. Your win is control. Control beats vibes. A small tax buffer stops the panic spending and the panic hiding. If you're stable and want to optimize, step 1. Look up your current bracket thresholds for your country or use your payroll calculator if it's accurate. You don't need the whole table memorized. Just identify your marginal rate, the rate on your next chunk of income. Step 2, simulate one raise. Write your current annual income, add the raise, and estimate tax only on the extra amount at your marginal rate. Example, raise is $360,000 a year, marginal rate is 20%, tax on raise is about $72,000. So take-home increase is about $288,000 per year, or $24,000 per month. Now you can negotiate with facts, not vibes. Step 3, if you have legal deduction options, retirement contributions, approved savings schemes, health insurance premiums, business expenses, list them and pick one you can automate. Automation is a weapon because willpower is a liar that disappears on payday. Step 4, if you get bonuses, treat them like unstable weather. When the bonus hits, move your estimated tax slice out immediately, then decide what to do with the rest. No hero stories, just systems. Now 2 more mini twists to keep you sharp. First, sometimes your employer's withholding assumes your monthly income stays the same all year. So one big month can make withholding jump like it got possessed. Next month, it may normalize. Don't rage quit your career over one weird payslip. Second, if you're married, have multiple jobs, or earn in different currencies, your final tax can differ from what payroll guessed. So the cleanest approach is always estimate marginal tax on extra income and park it. Simple, boring, powerful. Let's do a quick inner monologue check. You're thinking, okay, but I'm still scared I'll mess this up. And also, my income is messy. Some months high, some months dead. How do I plan? Answer, you plan with ranges. Use a conservative marginal rate for the top slice and keep a buffer. You don't need perfect. You need less surprise because surprise is what drains you. Another inner voice. But taxes are complicated and I hate paperwork. Same. Nobody wakes up excited to file. But the goal isn't to become a tax accountant. The goal is to stop making life decisions based on a myth. 10 minutes of clarity can save you years of hesitation. Remember the Golgappa plate. The spice only increases on the new ones. So stop starving yourself because you're scared of the next bite. Now the emotional close because this matters more than numbers. You're not bad with money. You were taught a scary story instead of the real map. You were handed a foggy windshield and told to drive faster. Of course you hesitated. But once you see the staircase, you stop looking for trap doors. You stop flinching at a bigger salary. You start treating income like a tool, not a threat. So the next time someone says, "Don't earn more," you'll lose it all to the next bracket. You'll smile. Not a smug smile, a calm one. The kind that says, "I know the rules now." And you'll take the raise. You'll take the client. You'll take the extra shift. Then you'll take the top slice tax, park it like a grown-up, and keep the rest moving toward your life. Your phone buzzes again. So, should I accept the raise? You type back, "Yes, brackets or stairs. Only the top slice gets hotter. Don't let the boogeyman negotiate your salary." And for the first time, the money story in your head sounds like yours, not somebody else's.